How can we implement academically proven principles to improve our success as investors? This is the question I hope to answer with this month's e-newsletter intro. If you're not already a newsletter subscriber, I'm sure you'll still learn something from this video. But why not head over to my website, scroll to the bottom, and subscribe, and you'll get so much more out of this. Anyway, I've been advising people with their investments for about almost 20 years, investing for myself for about 23 years, and I've never stopped learning along the way. Today, I want to share some of those learnings with you and also let my clients and potential clients know a little bit more about how I invest and why. Back in the fall of 2002, I bought my first ever stock, and then I bought a bunch more in 2003. And for a while, it was going pretty well because the markets overall were pretty strong. And it sort of misled me to believe that I'm actually good at this, picking stocks, and that this was really the way to riches when it comes to investing. Around 2006, I first became licensed to sell mutual funds at a bank. And in the decade that followed, I heard a lot from various active managers, many of whom thought they'd figured something out about the markets that helped them beat the markets when they picked stocks, and kept trying to tell me why they were the right ones to invest my clients' money with. Something I already learned early on when it came to the various mutual funds offered by a huge plethora of fund companies in Canada. And there always seem to be more funds than there are actual underlying investments. I think early in my career, there were probably about 5,000 funds in Canada. Nowadays, it's probably well over 10,000. But what I did find was that there was a bit of a correlation between lower costs, lower fund costs, and higher performance. I also found that highly diversified and systematic approaches tend to be more consistent in terms of the returns than when you hitch your wagon to a star fund manager who usually ends up either disappointing you in the end or uprooting from whatever fund they're with to sign with whatever fund company is willing to pay the most. It was kind of like having your favorite hockey player leave town for a contract somewhere else. As an aside, Edmonton loves you, Connor. Please sign that extension. Anyways, over the last 10 years of my career, I started to see a mounting pile of evidence that suggested that active fund managers actually have a hard time beating the benchmarks. Early on in my career, it was this 500-page tome by Ben Graham, well known by a lot of investors and financial advisors out there, The Intelligent Investor, that really guided me through what it takes to find value stocks. And in a way, you also kind of learn reading that book how, while there are a lot of timeless lessons in it, a lot has changed over the 100 years or so since it was first published. Highly efficient markets in the information age make it a lot harder to find that undiscovered gem out there. Later on in my career was this book by Jack Bogle, the founder of Vanguard, that dispelled a lot of the myths around stock picking and how passive, low-cost investing has a better chance of leading to good investment outcomes. A few years back, I came across this brochure from Dimensional Funds, which spoke directly to what I had learned over the years about investing and putting it all into 10 succinct points with illustrations. At that time, when I first saw it, with their permission, I actually created a blog post that you can still find on my website at muhs.ca/EBI. I entitled it Evidence-Based Investing, a 10-Step Program. For anyone still of the belief that you can beat the markets by picking stocks or paying someone else to, the 10-Step Program was there to help people go from a hope-based style of investing to an evidence-based style. Dimensional updates this brochure every year with updated numbers to prove that over time, every point still holds true. And you can find a link to the actual brochure if you want to look at it yourself in my latest e-newsletter, or just contact me if you're not a subscriber already and I can send you a copy. I want to take a few minutes to go through every point in here and expand a little bit out on each one. The first one is embrace market pricing. Markets are relatively efficient and already reflect all the information that's out there. If you think you know something about a particular stock or sector or region of the world, the rest of the market probably already knows what you know, and it's baked into the price. Believe in the markets. Trust the markets. Number two, don't outguess the market. This graphic here is actually based on a study they do every year called the Mutual Fund Landscape. I'll link to the latest brochure on that, as well as a little animated video explaining it in a bit more detail, can be found in my latest e-newsletter. What it highlights is how survivorship bias can actually cloud our perception of fund manager success. For if we only look at funds that existed over the past 20 years, it actually looks like almost half of them beat the benchmark. Indeed, 18% winners out of the 46% that survived the full 20-year period from 2005 to 2024 That number actually was a little bit higher in this study a couple of years back. It was closer to 50%. But when we consider the many funds that no longer exist, that merged or were just shut down over the years, it looks like more of a 1 in 5 chance. A 1 in 5 chance that whatever fund you pick today will outperform over the next 20 years. And again, the trend is not looking good there. Further, if you base your decisions on what did the best over the last 5 years, your odds are not much better. This graphic here shows how when choosing from the top quartile of fund performers over the past 5 years, the subsequent 5 years have actually a less than 25% chance of also outperforming. So past performance tells us nothing. It doesn't give us any leg up in terms of picking better funds. If we simply let the markets work for us over the long term, despite several spectacular market crashes and bear markets, they've done okay. They've done pretty well, actually. They've rewarded the long-term investor. It's important to get the full effect of this growth that we do not interrupt the compounding. Now, if you watch a lot of videos on YouTube, you'll find there's an endless supply of investment strategies being espoused by various YouTube financial influencers. Everything from dividend investing, buying growth stocks, or whatever else. The attributes by which we categorize stocks are called factors, and there's virtually an endless supply of them. I think there's at least 50, perhaps more. There have been found to be only a few that actually reliably have worked over the long term in terms of predicting future success. And that is to say, there is robust evidence that is repeatable over time as well as across different markets in the world. Primarily 3 of those factors with stocks are that over time smaller companies have outperformed larger companies, which is natural given the higher level of risk taken when you buy smaller companies. Value stocks have tended to outperform growth stocks. An exception, of course, being the last 10 to 15 years when growth stocks have done very, very well. But when we look at the bigger picture long term, it makes more sense to buy a stock that trades closer to its intrinsic value than to basically pay up for the higher potential for growth. Eventually things go bad and the higher cost we pay, the higher price we pay for growth might come back and hurt us. And then another natural factor is that when we buy companies that are more profitable, they tend to do better as well. Profits are great. They help companies pay off debt. They help distribute earnings to shareholders and so forth. So those are 3 factors that could potentially lead to higher returns. Of course, there's no guarantee of this. Nobel laureate Harry Markowitz once said that diversification is a free lunch in investing. And in particular, it's a free lunch when it comes to diversifying internationally. I think over the past 15 years, we in Canada don't need to be told this. Obviously, if you were investing for the last 15 years and have a diversified portfolio, you know that most of your returns came from US equities, not so much Canadian equities. But what has also been found over a longer time period, diversifying internationally not only has led to a higher growth rate overall, but it has even done it with less risk, a lower standard deviation. And that is what's meant by that free lunch. Of course, as mentioned earlier, we don't want to interrupt compounding. One of the most important things I've learned is that even if we interrupt compounding just for a week or a month or a few months at a time, when we try to time the markets and we exit our positions from the markets, it can be incredibly detrimental over the long term. Even if you manage to luck out and exactly in March or April of this year, you managed to sell everything right before Trump went on his tariff tirade, for example. When do you get back into the markets? When is the coast clear? Did you get back into the markets in mid-April when things were cheaper, or even as things rebounded towards the end of April? Or did you stay out for the same reasons that you got out of the markets? That's why it is so hard to time the markets. And every client of mine knows that we do not time the markets and never will. We plan ahead to have the right portfolio that can withstand the fluctuations in the markets while still being appropriate for our own personal risk tolerance levels and our time horizons. We never want to react after the fact out of fear. And on that topic, managing your emotions is such a vital part to successful investing. The most vital part, which is why probably most of the other books I've read over the years have to do with behavioral investing. Even though we tend to behave exactly the opposite way at Costco, we tend to run away when the markets go on fire sales, and we tend to flock towards whatever investments look hot today. which had the highest returns in the preceding couple of years. Doing so is a guaranteed recipe to failure. Of course, what helps in managing our emotions is looking beyond the headlines. While it is useful to keep tabs of what's going on in the world, the headlines often compel us to make mistakes with our investments, whether that is chasing us out of our investments because of something going on in the news, or shining a bright light on whatever the fad of the month or the year happens to be, pulling us towards investments that might be overvalued. Generally, I'll tell you, avoid the fads. If it's in the news, if everyone's talking about it, it's probably the time to look elsewhere. Stay away. I learned in my earlier years, when I was still on the Rolodex of a lot of mutual fund wholesalers, that when every fund company is talking about the same strategy, that's usually the strategy to kind of avoid at this point in time. So lastly, control what you can control. Take all of the preceding 9 points to heart. Have a financial plan and a strategy to allocate your investments properly and diversify. One thing you can predict and plan around is how much you pay in fund fees and how tax efficient your funds or your portfolio are. And of course, discipline. We saw the success the Oilers had in the playoffs when they had discipline, and we saw the mess that occurred when they lost discipline. There's no reason to believe it's any different in investing. There's no reason to believe that panicking out of your investments, losing your discipline, has any benefit whatsoever. So keep that discipline. Of course, there are a number of disclaimers that come with this, which I'll slowly scroll over for you, having to do with each of the previous points made. And I should say that all of this, while it is a brochure from one particular fund company, it does not necessarily mean you need to buy funds from that company in order to recreate the success that it outlines. It all can be recreated easily with any type of portfolio of passive index mutual funds or ETFs that are offered at a low cost. And all the same points apply whether you are an aggressive investor investing for the next 50 years, or if you are more risk averse and only investing for the next 10. Any questions? Do you disagree with any of this? Let's start a conversation in any case, either in the comments below or just message me directly on my website. If you watched this far and at least agree with some of this, give the video a like. It always makes my day also when I get an email notifying me of a new subscriber to my YouTube channel. I'm still small potatoes compared to a lot of the financial influencers out there, but maybe with your help I can reach 1,000 followers by the end of the year. Of course, if you really like this video and want to hear more from me, you can subscribe to my newsletter at the bottom of my website. What you'll get is an email monthly with updates on my latest content, as well as a lot of the other good stuff that I've read over the course of the past month, and that I think is useful to anyone who's an investor in Canada who's planning for their financial future. Anyways, thank you for watching.